Hello, everyone, and thanks so much for joining us today. I'm Steve, and I'm joined by Lee and Jen. We're part of the customer success team here at Snap Projections, and we're available to help you with any questions that you might face while using the software at any time. So you can give us a phone call, you can send us an email, and we're always happy to help answer your questions. Today's webinar will provide an overview of the recently released features that we've been working on over the last year. So we want to make sure that you can get the most out of those features. This session has also been reviewed by FP Canada and qualifies for 1 CE credit. So we'll share more details on the process to receive that shortly. We'll also be recording today's session, and we'll send you the recording tomorrow afternoon by email. If you have any questions during today's webinar, please feel free to submit those using the Q&A portal. So you'll click Q&A at the bottom, and then you'll submit your questions at any time, and Lee will be going through those to ask any of them that we can live, and Jen and Lee will also be responding to as many as possible in the chat. If we aren't able to get to your question, we will get back to you by email within the next few days. Just as a note, it is possible to join these webinars anonymously. So if you believe you've done that, so if you don't see your name listed anywhere in the Zoom webinar, please also include your name and or your Snap username, your email address, so that we can make sure that we get back to you with any questions that you submit. The webinar today qualifies for 1 CE credit in the category of financial planning for FP Canada, and it also qualifies for 1 CE credit in the category of professional development for CRO MFD participants. You do need to stay for the full session in order to receive that credit, and you'll receive an email 24 hours after the session ends. So tomorrow afternoon, you'll get an email with a link to a very short survey just asking for your full name and email address where you would like your CE certificate sent. So please complete that if you would like to receive the certificate. We'll be creating several projections today for a couple that is just about to approach retirement, and we're going to review quite a few of the new features and show you how they can be used in order to help you save time and create better projections for your clients. We'll also be answering your questions live, so please submit those at any time. When you're using the software, if you have any questions, you can click on Help at the top right corner and then click on Help Center, or use any of the other options in order to help tackle your questions. We're always available in order to provide webinars, videos, articles, and then you can also give us a call directly or send us an email in order to get back to you or set up a one-on-one call. With that, we're going to jump into the software and we're going to start building our scenarios for our joint couple. So we have a new plan for Deborah Cormier for 1968 and currently living in New Brunswick. We also have her husband, Wayne Cormier, for 1968. So now that we've added in the client's personal information in the top left, we'll see that there are 3 main sections to the tool. There's the scenario setup where we enter in all of the base plan data. This includes client information, general plan settings, expenses, incomes. You can either proceed through these pages one by clicking on them or clicking next at the bottom, or you can jump around as needed as you get new information and need to update the plan. Once you're done with the scenario setup, you can then go to planning pages where all of that data comes together to show our clients' lives on one page. From here, we can review information, make edits as needed, and then once we're comfortable with all of the numbers, we would proceed to the client report in order to create a custom client-facing document. You can navigate back and forth between any of these sections at any time by just clicking on the tab. For now, we're going to continue on with the scenario setup. We'll go to the general settings page. You'll see the first option that we have on this page is the start year of the projection. You have 3 options when creating plans for what start year you want to use. You can either use the current year and enter in all of your information like asset balances, debts, and so forth as of January 1st of the current year. Alternatively, you can use the current year as the start and then enter in the client's current account balances, like their current assets, current mortgage. But then you would want to prorate any activity on the accounts for the first year of the plan. So you might reduce their total contributions to what's remaining in the year. You might prorate the rate of return on the planning page. And then the third option is you can start the projection as of 2026, and then you would enter in the expected balances of the accounts January 1st of that year. And this becomes much more common in the last quarter of the year. We can typically skip the last couple months and just start the plan fresh as of 2026. Our clients are looking to retire in 2 years at age 60. So we're going to enter in that as their target retirement age. And then we're going to show the projection until age 100. We have the FP Canada guideline assumptions for inflation, and then we've reduced the guidelines by our expected management fees in order to arrive at a net return assumption for the plan. I'll click next and go to expenses. There are 3 ways that you can enter expenses in SNAP. The first is to enter them directly on sub-pages within the software. So for instance, if you go to the debts page, you can add in a mortgage, which would be a major expense that your client has, their monthly mortgage payments. In addition to entering sub-page expenses like debts and insurance premiums, you can also enter in base expenses. So this would be anything that you have not included elsewhere in the software. So this is things like groceries, transportation costs, property taxes. You can enter in the client's total annual net of tax need, and this will be adjusted over time for inflation. So we're going to enter in 84,000 as the client's target base annual spending need. And then the third way that you can add expenses is to itemize them and enter in specific timings or dates that you want them to occur. So in this case, we're going to have some additional travel of $10,000 as a joint expense. We'll index that with inflation, and we're going to start that when they retire and run it until age 69. We'll also highlight it so that in the reports, it has its own legend item, and it can make it much easier to explain what's happening in terms of the client's cash flow. They're also looking to do a fairly large renovation shortly after retiring, so they need 150,000. That'll be a joint expense. We're not going to inflate that, and we're going to have that expense just for 1 year at age 61. So we'll enter 61 in the from and to age, and that's going to create a one-time expense of 150,000. We'll also highlight that in the report. I'll click next and go to incomes, where I can enter in Deborah's current salary, which is $120,000 per year. We'll adjust that for inflation. So you can actually either set a specific percentage that you want to index their salary, or you can just clear the value and it will automatically link that to the general inflation rate in the plan. That's being entered as employment income, so SNAP will automatically deduct CPP and EI. It'll tax it appropriately, track and earn RSP eligibility, and then it will run it until the end of the year before they retire. An important note is that where you see ages in a lot of the cells throughout SNAP, you can also enter in a specific date if you prefer. So by clicking on the gear icon, you have the option to enter in a specific year and day in order to prorate the income or the expense for that partial year. We could also add other income. So if they had a rental property, we could add that here. We could also model future inheritances. And we can enter in defined benefit pension plans on this page as well. So Deborah has a pension plan that she'll receive for a total of 37,000. That'll be a 60% survivor benefit and no guaranteed indexing. And then that drops to 28,000 once the bridge benefit drops off. So this is the base benefit plus bridge, and then this is just bridge starting at age 65. In the top left, I can toggle between the clients. So I'll go to Wayne and enter in his current salary of $90,000 a year, and then link that to the general inflation rate. Going to Deborah's assets, you'll see there's a default non-reg. This is so that SNAP has a place to allocate future surpluses. Let's say the client has more cash flow than they need in a future year. SNAP would deposit that money into the non-registered account. It's important to have a non-registered in the projection in order to keep things clean and quite readable in terms of the planning page and the reports. In this case, they already have a non-registered investment, so I'm going to delete the default that's been added and just enter in their existing non-reg balance. So it's a joint account invested as 50% fixed income, 50% equity. She also has a TFSA with 120,000 invested as 30% fixed income, 70% equity. And she has an RSP for 150,000. Now that we've entered the accounts, you'll see that the rate of return has been brought in from our general settings page. We could adjust it on an account by account basis if needed, but I'll just leave the defaults intact. There are also tabs across the top of the table. So I can go into the TFSA settings, RSP settings, and I can customize those as needed. So if they had additional carry forward room, I could enter that in here. Similarly, for the RSP, I could enter in any pension adjustment, such as her $15,000 pension adjustment for the defined benefit plan that she has, and then I could enter in any carry forward room. Going back to the table of accounts, I'll now switch over to Wayne and enter in his balances. I'll delete the default that was added. We can see the joint non-reg gets populated automatically. And then I'll enter in his TFSA and RSP. Now that we've added the financial assets, we can scroll down on this page to access the real assets, where we'll enter in their home, which has a current value of 600,000 and cost base of 400,000. We can model a future purchase or sale of the property, either using a date or the client's age. So you have the option to do either. And then we'll enter that as joint, and we can indicate if there's capital gains tax applicable on the sale. I'll click next and enter in their remaining mortgage, which has a balance of 55,000, interest rate of 5%, and monthly payments of 2,500. And then I'll link that to the home so that if we sell the property before the debt is repaid, Snap will finish off the balance using the proceeds. And then as the last step in the scenario setup, I'll go to the government benefits page where I can customize the start age for CPP and OAS, as well as the expected benefit amount. So I'm going to, in our default scenario, use a start age of 65. And then you'll see that Snap doesn't have all of the historical contribution information it needs to calculate the client's expected CPP. So it simply defaults to the national average, which is 57% of the maximum. In this case, we expect Wayne will receive about 75% of the maximum starting at age 65. We also expect to start OAS at 65 for 100% of the benefit. Toggling to Deborah, I'll change the CPP start age to 65 and then set the expected benefit to 80%. And just like that, we've now finished the scenario setup for Deborah and Wayne. You'll see on the left, we do have additional pages available as needed. So we could add insurance policies, enter in an RESP, customize additional settings, or add a corporation. But for the time being, we're all set and we're ready to proceed to the planning pages, where all the information we've entered so far will come together to show Deborah and Wayne's life on one page. Now, the planning page can seem overwhelming, but once you know what you're looking at, it's quite intuitive and very powerful. This can also be a great way to present your plans to your clients once they're complete. In the top left, we have the start year, which we set as 2026. We have the age that our clients turn in that year. Then we have the calculated base expense value. This is how much the client has available for cash flow outside of the projection. So this is net of everything modeled in Snap. This 117K is calculated by taking their employment income of 210, subtracting off their taxes and premiums, and subtracting off their mortgage payments. So that leaves them with 117,000 that they can allocate for savings or spending. Now we have two options for allocating savings in Snap. We could turn on the cash flow management from the first year of the plan. So instead of starting that at retirement, we would start that right away. And then we could set a target level of spending. And in that case, Snap would save any surplus cash flow into the client's accounts automatically. The other option is we can manually contribute their current savings amounts from their individual planning pages. So I'll go to Deborah's page, I'll scroll to the right, and you'll see that there's a lot of other great information available. So we can see their marginal and effective tax rates, their account balances, contributions and withdrawals, the return assumption, and any blue or purple value is completely editable. So I'll go to the TFSA, enter in $10,000 and copy that down. This is going to help me max out the TFSA regardless of what the contribution maximum is in the future. Snap's going to calculate that and then adjust my contribution once I run the scenario. Deborah's also contributing $5,000 per year into the RSP. So I'll enter both of those, click run, and then Snap's going to update the contributions accordingly. So now if I take a look, Snap has adjusted the expected contributions based off of inflation and then entered in my RSP deposits. Going to Wayne, he's currently maxing out his TFSA and his RSP. So I'll do 10,000 into the TFSA and 20,000 into the RSP. Again, once I run, Snap applies the guardrails in place to help prevent me from making an accidental overcontribution, and it calculates the expected maximums in those future years. Now on the combined planning page, the calculated expenses have been adjusted for those contributions. So the client has about $90,000 a year available for personal spending outside of the projection. That process continues until they retire in 2028, at which point their target spending of $84,000 a year is adjusted for inflation. We have the additional travel, the renovation expense, and that's all going to be funded automatically by Snap using a combination of their guaranteed incomes, such as the pension and government benefits, and then withdrawals out of their financial assets. So we can see Snap is using a tax deferral strategy in order to efficiently withdraw from the accounts over time. So if we continue all the way to the bottom of the plan, we can see that the clients have a small buffer still remaining at the end. They've got about 200,000 in their investments, and then they still own their home that they could use either to downsize, borrow against, or whatever they may need to do. So that's the first base scenario. I'm just going to pause there and see if there have been any questions that have come in so far, Lee.
Great. Thanks a lot, Steve. Okay, first question, we've had a few about the CE credits and just making sure how you can let you know that you would like to get a CE credit. Can you go over that again?
Yes, so tomorrow at roughly 1 p.m. Eastern time, you will receive an email to the email address that you registered to today's event. That is going to include a link to the recording, as well as a link to a type form survey where you will provide your name and email address for the certificate. If you don't receive that email for any reason, you can send us an email tomorrow at support@snapprojections.com, and we can give you a link to that type form in order to submit your request.
Great. So if you're anonymous right now, it's okay.
Yes, it's okay because that'll be different than how you registered for the event. So all of your emails that you've been getting confirming the registration and giving you the link to today's session, that's going to be where we send the invite to. And even if you don't receive that, you'll be able to get access to the certificate.
Right. And just one quick question about usually in the webinars, as you're adding assets, you delete the initial default non-registered account, but you could use that account. So just kind of a clarification of why are you deleting it and not just using that?
Yes, you can absolutely, you would just need to modify the settings. So typically the default to be conservative is set as 100% cash. So you can either adjust the asset allocation once you've set your account value. So you would either use the existing default and rename it, or you can delete it and add your own.
Great. Thanks a lot, Steve.
Yeah, thanks guys. All right, so we've got our first scenario complete. We can also review the results of the plan through the charts at the top of the planning page. So if I click on that, we can get a high level overview of what's happening. So we've got the client's base expenses. This is that 84,000 a year target, inflation adjusted over time. We've got additional travel coming in for the first decade. We've got the renovation, income taxes, debt payments, and then contributions to investments. And then on the inflow side, we can see where their money's coming from each year. And then we have their net worth, which shows a breakdown of their available resources. And all of these charts are fully interactive. So if you add or remove sections to the chart, you're going to be able to adjust the view. You can also mouse over individual years in order to get pop-up information. So if our clients were fairly far off from retirement and they were just looking for a high-level overview of what to expect and whether they're on track, this might be all that we need to do. And we could go from the planning pages into the client report. We could either use our default settings or customize what pages we want to include, and we could provide that final document to them. In this case, because the clients are so close to retirement and they need to make a decision fairly soon about whether to retire, whether to start withdrawing accounts, whether to take CPP and OAS, we're going to do a bit more analysis and show you some of the new tools that have been added to Snap in order to optimize the plan and provide the clients with the best possible path going forward. So I'm going to update the title of this first scenario. So I'm going to click on the title at the top and change it to scenario 1. And then I'm going to copy this scenario. And then I'll rename this to scenario 2, defer CPP. So the first thing we're going to see is whether the client should take CPP at 65, which we modeled in the original, or consider deferring it until age 70. So we'll go into scenario setup and then government benefits. And we're going to first adjust the start age to 70. And then in this case, because the clients are going to be retired for that 5-year period, we're also going to reduce the percentage of maximum slightly by 5% in order to account for the fact that they will not be contributing into the enhancement program at that stage. So by default, when you defer CPP, Snap assumes that they will get both the deferral benefit and the CP enhancements that are gradually being phased in. If the client is already retired, they just wouldn't receive that CPP enhancement. So I'm going to be conservative, reduce the expected amount by 5%, and then I'll do the same for Wayne. So I'm going to defer to 70 and then reduce this to 70% of the maximum. Going back to the planning page, we can see the impact of that on the plan. So if we go to combined, we can expand the benefits section using the box at the top of the column. And now we can see that the CPP starts at age 70 instead of 65, and we have an increased value being received at that point of the plan. If we scroll all the way to the bottom, we can see that there's more money expected to be left at the end of the projection than in our original case. So this would suggest that deferring CPP is advantageous on a longevity basis, which is the common understanding. So it does align with what we would expect to see. Next, I'll copy this scenario and see whether they might also benefit from deferring OAS. So if it makes sense to defer CPP, we can do a similar approach and see whether they might also want to defer OAS till age 70 as well. So I'll update the title, scenario 3, and then I'll go back into scenario setup, scroll down to old age security, and I'm going to adjust the start age to 70 here. Snap will automatically adjust the maximum expected for the deferral benefit. And then we can go back to the planning pages. So now that we have 3 scenarios, we can use one of our new tools, the compare scenario button, in order to look at the pros and cons of the 3 options available to the client. So I'm going to select all 3. You can do anywhere from 1 to 5 scenarios using this tool. And then we can compare them across either a set of metrics. So we can use this table format, which has a bunch of metrics. You can customize what values you want to include by clicking on select metrics at the bottom, and then you'd be able to check and uncheck which ones you want. And you can also then save those metrics as your default settings. For instance, with goal progress, we can see that the first plan had a small surplus of 3%. And then by deferring CBP, that increased to 7% of a surplus. And then a small increase to 9% once we deferred both CPP and OAS. So we increased by 4% and then 2. So we can see that the CPP deferral had about twice as large of a benefit because it has a much higher deferral benefit than the OAS does. We can also use other metrics like the lifetime personal tax and the lifetime government benefits to see what the differences are in the various scenarios. So we had 3 million of total lifetime government benefits in base case, 3.5 by deferring CPP, and then roughly 3.8 with the deferral of OAS as well. Now, in addition to the metrics, we also have the trends section, which allows us to compare the scenarios over time. So here what we can see is that scenario 1 is actually preferred to the other two scenarios for roughly the first 20 years of retirement. So until age 84, we can see that the purple line has a higher after-tax estate value than either scenario 2 or scenario 3. And that's because they've deferred government benefits, so they've had to use up more of their financial assets, and therefore they would have less to pass on to their beneficiaries. So you can use this chart to help have a conversation with your client about the pros and cons of the different options. As we can see, scenario 3 is the most extreme. It has the lowest initial value and then the highest at the end. So the client may not want to go all the way to defer both benefits. They might just want to use scenario 2, taking advantage of the increased value from CPP deferral without deferring and too much of their government benefits and having to use up too much of their financial assets. So we're going to go with scenario 2 as our starting assumption for government benefits. And so let's go back into that plan and take a look at what the taxable income would be in that projection. So if we go into scenario 2 and go to Wayne's individual planning page as an example, we can see that because they have no OAS or CPP for the first 5 years, and then they have only OAS in the next 5, they have fairly low taxable income at the start of retirement. So we may benefit from taking out additional income in the early years in order to avoid taking out money later on at a 28% marginal tax rate. Or if both of them were to pass away early, we would avoid the RSPs being taxed at a full marginal rate. So SNAP has added a new taxable income targeting tool that we can use in order to see whether taking out a blend of non-registered and registered withdrawals could be preferred to the default settings in SNAP, which relies on a tax deferral approach. So I'm going to copy scenario 2, and we'll run our fourth and final scenario, which is going to be to set a taxable income target. So I'll update the title, scenario 4. We're going to still defer CPP, so we've copied that scenario, and now we're going to add a taxable income target of $51,000 a year. And we're also going to use the new TFSA top-up tool that I'll show shortly. Going back to Wayne's personal planning page, I can turn on the taxable income targeting tool from the top of that column on the planning page by clicking on the gear symbol and then enabling taxable income targeting. That's going to create a new column on the planning page that I can use in order to set a target that SNAP will then work to achieve as best as it can. By default, it starts the target equal to the original value that was there before so that it doesn't update the plan. And I'm going to set that to $51,306. So this is the top of the first taxable income in New Brunswick. So we're going to try and take out as much as we can at the lowest marginal tax rate and try to avoid having to take anything out later on at 28%. I'm going to copy that down to age 100, and I'm going to tell SNAP that this figure is as of 2025. So that's current dollar values, and we want to inflate that forward for future years. So I'll check the box. And now SNAP is going to try and achieve this target each year going forward. So now if I click run, SNAP is going to adjust its withdrawal strategy. And we can see that it's now reaching the actual amount is equal to the target that we set for the software. And now it's using up the full 23% bracket. And we can see that we're no longer having to take anything out later on at 28%. We're just cleanly staying within that 23% bracket the whole time. And Snap is achieving this by taking a combination of registered withdrawals and non-registered withdrawals to reach the exact target. We can see that Snap is still able to make lump sum withdrawals for things like the renovation. So it combines all of the automated tools that are available in order to try and create an optimized scenario. We now have a non-reg balance that is maintained for about a decade of retirement. And so what we could do is we could shift that money over into the TFSA each year. And we have a new tool to do that. You can go to Scenario Setup and then Assets. And then you would click on TFSA. And you can click Maximize TFSA Contributions for this scenario. And what this feature will do is it's going to pull on an annual basis any balance that's available in non-registered assets and move that into the TFSA if there's available contribution room. So it's just going to gradually shift that money over and try to reduce taxes payable on non-registered investments. So now when I go back to the planning page, we can see that Snap is now topping up the TFSA for as long as there's a non-reg balance, and it's just taking out a bit extra from these accounts each year in order to achieve that. So now we've set a target taxable income and we've topped up the TFSA. So we're now looking at a very optimized scenario. Let's see what the impact would be on the client's long-term outcomes. So we're going to go back to the menu at the top and we're going to click Compare Scenario. And we're going to exclude scenario 3 because we ruled that one out as an option in our previous comparison. Now we just want to see whether scenario 4 is better than our scenario 2 and 1. So again, we can either use this summary table and the metrics available here, or we can go to the trends and take a look at the chart that shows the values on an annual basis. And the amazing thing in this case is that scenario 4 is better than scenario 1 and 2 in every single year that we've projected. So we're no longer facing a trade-off decision where one is better than the other for specific periods. Scenario 4 has just created a fully optimized and efficient plan to the tune of upwards of several hundred thousand in any year of the projection. So by optimizing for government benefit timing, taxable income, and TFSA top-ups, we've created a roadmap for the client to set themselves up for a great retirement. So that's how we can go through the process of using the new tools. Now, the goal of today's webinar is to show you how to use these tools in the context of a full planning engagement. If you want a more detailed technical overview of how these tools work and the different use cases, you can go into our help site at the top, click on Help Center, and then you can search for the two tools, so taxable income targeting. You'll see that there's a dedicated 12-minute overview video that provides a bit more information about different use cases. You can also read the article in order to fully understand how Snap is using that target in order to help achieve a better outcome for the client. I'm going to pause there and then I'm going to go into the main question that a lot of users have, which is how do I pick a target for the plan? So I'll pause first and then we'll move on to that question.
Great. Thanks, Steve. I might have missed it, but did you show how in the comparison you can select to print it, whether you're in trends or the
Great point.
metrics?
I didn't mention that. So from the comparison table, in the top right, you can click print, and that will allow you to either print it to your printer or save it as a PDF to share with the client. So you can use exports from the comparison in order to help with your client conversations. And before you print, I mentioned before, you can select which metrics you want to include. So you would just check or remove. Same thing on the trends side. You can select different charts. Now, in my case, I've focused on just the estate after tax, but there are a lot of other charts that you can select from if they would be helpful for your conversations.
Perfect. Yeah, and just one more question about RIF income. So we had a question whether SNAP will automatically use the RIF income for pension income splitting at age 65.
Great question. So right now in SNAP, the RSP and RIF column is split into two categories. So there's the RSP period of the plan and then the RIF period. And that is currently determined by going to scenario setup and then assets, and then setting the conversion age. So if the account has been converted, any withdrawals from the account going forward will be counted as eligible for pension income splitting and for the pension credit. We realize that this is a fairly rigid approach, and so we're actually in the process of creating a toggleable feature that will allow you to say that you want all registered withdrawals starting at age 65 to qualify for pension income splitting and credits, assuming that in reality they would be coming out of a RIF. So you will not have to convert the accounts once that feature is launched, and we'll share more detail once that's available. But the goal will be to allow you to set all registered withdrawals as of age 65 to qualify.
Okay, thank you.
Awesome. So we now have a optimized plan. We set our target as 53,483, and I selected that based off of a few factors that we'll go through in the form of a few slides. So if we go here. So the first question would be, what reference values might you use for the taxable income target? And three common ones are marginal tax brackets. So in this case, we used the top of the lowest bracket in New Brunswick. Another example might be the third bracket in Ontario. So if you have a client that's fairly high income, they might be 50K now and then 150K later. So rather than having those large discrepancies, we want to try and take out at 93K inflation adjusted for the whole retirement period, trying to avoid any of those high tax brackets that they might face later on. And you can access credits for the various provincial levels through taxtips.ca is the best resource that we have come across. I use that frequently, but you would go to taxtips.ca, find your province that you're interested in, and then it'll provide you with all of the tax brackets broken out by the combined federal and provincial levels. Another set of reference values that you might use for the target is based off of credits and benefit thresholds. So some benefits will start to get clawed back, such as the OAS. So you might want to take out as much taxable income as you can while avoiding any OAS clawback. So in that case, you would set your target to 93,454 and take out anything up to that level. Another example would be the reduction on the federal age amount credit, which starts to get reduced at 45,000. So if you want to try and keep that intact, you would just set that as your target level. And those again are available on tax tips. They have a wide range of credits and thresholds available there. And then the third option, which can still be based off of the marginal and tax credit values, but the other option is to use round numbers. It's easy to model, understand, and implement. So you might say, let's target $40,000 a year and try to just smooth out your taxable income for as long as we can. So those are reference values. And then how you pick the exact level is typically based off of two things. There's the opportunity. This is how much tax or benefits can we save by taking out money early rather than deferring it. So here we have an example where we can take out taxable income at a 20% marginal rate versus 35 later on. So we're essentially saving 15% in taxes payable by taking out extra money early. So that's the opportunity. And you can review the individual planning pages to get a sense of just how large the opportunity might be for your client. As another example, if they're worried about passing away early, that might get taxed at 50 or 52%. So if you can take it out early at 30% even, you're still saving a 20% difference. But the opportunity gradually gets offset by the cost of the early withdrawal. So when you take money out early that you don't need for spending, you have to put that somewhere. And typically that would go into a non-registered investment. Or another way to think about it is you might not actually be putting anything into your non-reg, but you would otherwise have taken money out of your non-registered account rather than taking the larger RIF withdrawals. So in the difference of plans, you're going to have more money in a non-registered account, and that's going to have a tax drag on the investment return. So let's say that there's a 1% annual tax drag. You initially save 15%, but then over the next 15 years, you're paying that back through annual taxes on the investment income. So there's a bit of a trade-off there. And unfortunately, we don't know what the opportunity and cost are going to be because it relies both on some known factors like the client's contribution room. So if you can put the extra withdrawals into a TFSA, that's going to remove the cost aspect of the trade-off. So if you can get money out early and put it into a TFSA, that tends to make sense because there's no cost of ongoing investment return tax drag. But there are also unknown factors such as the client's longevity, rates of return, and spending needs. So we can see that the longer a client lives, the lower the opportunity because they would have been able to withdraw that money in future years at fairly low brackets, and the higher the cost because we have more and more years of tax drag in the non-reg. Similarly with rates of return, if you have a high rate of return, you have a high cost because there's more taxes payable in the non-reg, and you also have a higher opportunity because the future RSP balance, either that needs to be withdrawn or that would be taxed at the estate, is going to be higher than it would be otherwise. So we have all of these moving parts and unknown factors. And so that's why SNAP can be very helpful in order to actually model out the different scenarios, compare outcomes, and look at different assumptions to see how that might change what the optimal or recommended approach is. And then the final factor that is important to consider are client preferences and risks. So if a client has longevity concerns, if they are really worried about running out of money before they pass away, then you may want to take out less money early because really if they live long, they're going to want to leave that money in the registered account on a tax deferred basis. But if they have more than enough money for their spending and they're really worried about a huge tax bill in their estate, then you could look to take more money early and reduce that risk on the estate tax. So now that we have our optimized scenario, I'll go back into the software, and the final step would be to go to client report and create a customized report for the scenario. So similar to the top section where there's 3 sections to go through, the same process is followed with the report. So you would start with report builder. This is where you can choose what pages you would like to include in the report. You can also toggle at the top in order to create what we call the snapshot. This is another fairly new tool in the software. And this just allows you to create a 1 or 2 page simplified report that really focuses on the key aspects of the plan. So I'm going to use snapshots only, and then you'll see that everything else has been grayed out. It wouldn't be included in the report, and I'm just going to focus on the snapshot section. And then in order to remove a page that I don't want, I can drag that anywhere outside of the included pages section. So I'm going to drag a few pages out just in order to keep it clean on one page. So now I have my 6 snapshots. I can then go to report editor. I can review the content on those pages. I could add additional custom bullets if I wanted. So I could enter in additional travel budget. Starting at, and then on the right, you'll see that we can actually reference specific variables in the plan. So here I'm using their retirement age and retirement year. And that way, if I change anything in the plan, it's automatically going to feed through into the report sections as well. If I go back into the planning pages, I can use things like the recommendation tool. So if I click recommendations, I can see what they could do with this overfunded status within the plan. So I could calculate the sustainable spending level that's going to use up that surplus. So they could spend up to $4,000 more per year in order to use up the surplus that we created through our optimizations. And now when I go back into the report, that value is going to show under the goal status. So because we calculated it on the planning page, it's now going to show as an option for them within the report. And then on recommendation summary, we can enter in any custom text that we want. So I'm just going to add in some congratulations and instructions on next steps. And then that's going to create our custom one-page snapshot. So we can see a nice clean, they're on track, they've got surplus, their money is funded in retirement. We can see when they're retiring and then their final estate. So quite customizable and very easy to digest for the client. So that's everything in terms of the optimization process for Deborah and Wayne. I'm going to pause there and see if there's any questions before I go through a few final notes, and then we can open it up for a full Q&A.
Yeah, I think if you want to go ahead, Steve, we can,
Okay,
some of the questions relate to things earlier, so we can leave them till the end.
sounds good. All right, so in terms of other features that we've recently launched, just want to remind everyone under this scenario setup, under the insurance page, you can now add not only life insurance, but disability and critical illness policies as well. So these were recently added. And then with all three policies available on the planning page, you can also complete needs analysis for any of the insurance types. So you can run through a series of calculations in order to see whether the client might need more life, disability, or critical illness insurance. If you'd like to learn more about these tools, you would go to Help and then Help Center. And then under our webinar page, we have a dedicated webinar that we went through several months ago to highlight how to take advantage of those tools. So the modeling insurance coverage and needs analysis webinar. We also added the ability to change the interest rate on debts in future years. So just like you can change the rate of return on an account in the future, you can now change the rate of return on a debt. So let's say that they're going to refinance in a year at a different rate. You would just adjust that here, and Snap's going to factor that into the calculations for the loan. We also, of course, have the software fully supported in French, and Jen, who's on the call with us today, is our French specialist. So she is amazing and available to help you in French language. So if you would prefer to interact with Snap in French, you can change from the user settings page, you can change your language in the software, and then you can also reach out to us by phone or email in French. And then a lot of the steps that we went through today, like the target taxable income, the TFSA top-ups, we manually went through the process of creating different scenarios and enabling those features. But that is the next thing that we'll be working on in Snap, is automating the process of finding the optimal plan. So we've been adding the building blocks that are needed in the software in order to create an optimal plan. And now we'll be working on running a series of projections in the background and then helping you to find the best one as quickly as possible. I want to emphasize that we will be focusing on still maintaining the transparency and control that you're used to today. So it's going to be the best of both worlds, where you'll have an automated start to the planning process where you get a optimized plan very quickly, but you still have final say through things like overrides and customizing settings in order to really understand what's happening in the plan and still have full control over what you want to show. And the last note before we open up for questions, we do have an upcoming Q&A session. So a reminder that from our Help Center, you can go to our webinars page, and we have ongoing walkthrough and Q&A periods that you can sign up for. So if you want more one-on-one interaction with Snap, you can sign up for our drop-ins. The next one is on October 15th, and that's going to go over presenting Snap to your clients. With that, let's open it up for questions, and we'll get through as many as we can. Again, we'll get back to you by email if we're not able to respond today.
Okay, thanks a lot. And thanks for all the questions that we've been receiving. It's great. Try to get through some here in the next 10 minutes. One question, Steve, about snapshots. And can you go over again just how you get the goal chart where it's telling you what percentage of the goal you're reaching and maybe how much longer you'd need to save or how much more you could spend.
Yeah, so let's take a look at the client report first. So in client report, under the report builder section, there's this page called goal status. So this is what you'll want to have in your report in order to include that in the report view. Then if we go to report editor, if I go to that page, you'll see the goal progress of 108%, and then any of our recommendations that we've calculated would show up here. We can calculate recommendations from the planning page under the recommendation tool. So we would click on this, and then we would use either sustainable spending, available savings, lump sum, or retirement age. So any of those we can click calculate, and then the calculated value will show up as an option for the client within the report. So if they're underfunded, we can actually tell them how much they would need to reduce their target spending by or increase their savings by if they want to bring the plan on track. Or in this case, because they're underfunded, we can tell them how much more they could spend in retirement or how much earlier they could retire if they want to use up that surplus. And once you've calculated those values, that's when they'll show up on the goal status page of the report. So here we can see the spending has been brought in.
Great. And then those defaults, can you go over how, if you do want to set up your own custom default again, just those those steps and a little bit
Yeah,
slower?
so if we're on the report builder, let's say that you've, um, I'll go to a full report in this example. So we've got the cover page, our note to reader. We'll use the snapshot as an executive summary. And then maybe you've deleted some of the report pages that you don't need for your clients. So I can either select them and then hit delete on my keyboard, or I can drag them into the gallery section. Once you've got your custom report pages that you want, you would save and then click defaults and save the current page settings for new scenarios. So that's going to automatically use those report settings anytime that you create a new client and new projections for them. If you access an old client that you've already customized a report for, and you want to use your template or your default, you would just click on defaults in that existing client and say reset current page to saved settings. And that's going to update the included pages. And this default functionality is available all throughout Snap. So it's on some of the scenario setup pages. It's on the report editor pages. So you can set up your custom settings like your logo and any firm information, and then you would click save default, save current page settings for new scenarios.
Terrific. And then once you've got what you'd like, or if you're not sure what you'd like and you want to see some examples, you can go to our help, and we do have articles that give you an example 2-page snapshot, 1-page snapshot, and which snapshot summary tiles to include to make those work.
Yeah. So we've got common templates, and we've got some videos that help to show how to set everything up. So that's been a common theme throughout today's presentation. There's a lot of tools available in Snap. We want to make sure that they're on your radar, but we can't go through the depth of instruction on a dedicated webinar. So really, if you have any questions about areas of the software that you don't think you're taking advantage of, or you have questions, you can check out our help site, see if you can search for key terms like report samples. You can find sample reports. And then if you aren't able to find what you're looking for, you would send us an email or give us a call, and we're always happy to help make sure that you're getting the most out of the software.
And we've had quite a few questions as well about the comparisons and how it's a PDF that you can generate, but how could you include that in your client report? At this time, it's a separate PDF. It's not part of the client report. And that was a decision that was made when we created the scenario comparisons. But the product team is always happy to hear more about, if you did want it to be in the report, why, how important would that be for you? What problem would that solve for you? We haven't had too many people asking that it be included. Usually when we mention that's a separate one, pretty much so far, the feedback has been okay with that, but definitely send us an email to support@snapprojections.com if it is important for you to try to include that in the report.
Yeah,
Let's see. So we had a couple other questions just about the planning page itself and the taxes. So the lifetime personal tax is available in the comparisons, but it's also available here on the planning page. And you'll see that the total tax includes the federal and provincial taxes, like for each given year. What it does not include is the OAS clawback. So that was a question whether the clawback was included.
gotcha.
And and it is a sum of the federal and provincial taxes. So that was the other question. Okay. Um, how about if you have a corporation and you would like to use the taxable income targeting feature?
Great question. So right now in Snap, you can add a corporation to any plan if you're on the advisor business subscription. So you would click add corporation. That's going to allow you to enter in, all of the settings for the corporation, any investments, incomes, and so forth. Right now, the corporate module in Snap is separate from the personal side. So all distributions from the corporation need to be manually entered at the moment. So you would enter in, say, non-register or non-eligible dividends or eligible or capital dividends. What will happen is that's going to get brought into the personal side. So the income will get factored in, and you can still use the target tool to wrap other withdrawals around those dividends, but Snap will not currently determine the level of dividends based off of the target taxable income. So it's not going to increase or decrease dividends, but it will use those towards the total taxable income that you want to achieve. And so then it might take out an extra 10,000 from the RSPs if you don't have enough in dividend income to reach your target. So they do work collaboratively, but you just need to manually enter in the corporate dividends. And linking the personal and corporate side is a high priority for our team. So we're just looking to figure out what the best timing is to look to automate that process of having Snap able to pull the money out. So if that is a high priority for you, the automated corporate distributions, please reach out to our support team, just because everything that we do at Snap is based off of your feedback, and we have amazing collaborative clients. So we need to know what is most important to you, so that we can make sure that we're providing as much value as possible.
All right. Yeah, right at the end here, but we could probably just tackle one more question, which was about scenario comparisons again. And to be comparable, um, can you compare two scenarios, for example, that have different retirement ages or where one spouse passes away before the other?
Yes, so this new comparison tool is quite a bit more flexible in terms of what you can compare. You may be familiar with our old tool from over a year ago. It had certain limitations, but this one you can compare scenarios from previous years with current scenarios. So that can be helpful for having conversations about the client's progress. You can essentially see where they are today versus where they were previously. In addition, you can also compare scenarios with different settings. So if I go into this comparison, you'll actually see what the settings are for each of the different plans. So if you have a different retirement age in one plan than another, it'll show here in addition to allowing you to compare them. So you'll have that information and the ability to compare them. Really, the only things that have to be the same are the client's name, their date of birth, and I believe that's it.
Yeah, I
The
think that's
only
it.
other, yeah, the other thing to note is that you will not be able to compare the scenarios that you've selected beyond the cutoff for the shortest plan. So essentially, if you have one plan where both clients pass away as of age 95, then that's as far as you'll be able to compare all three scenarios, because there just isn't data for the other plan beyond that point. But otherwise, the comparison is quite flexible.
Terrific. Well, I think we better leave it there.
Yeah, awesome. Well, thanks everyone so much for joining and for your business here at Snap. We're excited about all of the new features that are still on the horizon. Please continue to let us know what's most important for you. You will be getting an email tomorrow that'll have the recording, the CE credit type form to submit your request for the certificate, and it will also request feedback. So please let us know whether today's session was helpful, whether we can provide different types of overview and training, and then anything that you'd like to see in the software that would be valuable for you.